my favorite chart lately is to overlay the S&P 500 on top of 10-year note yields. And they really aren't correlating as much as they should. And maybe the catalyst for that was the fourth quarter of 2018. Your thoughts?
Yeah, it's very correct. 10-year Treasury yields have moved differently than risk assets, generally speaking, whether it's the S&P 500, whether it's high yield, investment grade spreads, emerging markets. Risk assets are doing well in 2019, and Treasuries are holding up. But we're not having a bull market in Treasuries. They're just not going up in yield. And I think the primary reason for that is twofold. One is the Fed has on the way to stopping quantitative tightening. They'll stop balance sheet shrinkage later this year. And secondly, the interest rates in the United States are much higher than they are outside the rest of the world, and that there's been money coming back to the U.S., back into the bond market and the equity market, and that's supporting keeping bond yields relatively low as we have a rally in risk assets.
Now, many investors that I bump into, that's the first thing they want to talk about. And even though they feel guilty because they thought a year ago, January, that rising rates would kill the rally, they're now more concerned that global macro and all the issues described are still pushing rates with a voice towards the notion that global horsepower isn't going to pick up. Do you see a recession in your crystal ball anytime soon, Michael?
Good question. We do not see that. We see evidence that the U.S. and global economy is bottoming sometime between now and the end of the second quarter. Green shoots are evident, it's sporadically around the world, but most importantly, policies becoming much more supportive of economic growth, both in the United States, in Europe, in China, and even to a lesser degree in Japan. And also emerging markets around the world have adopted a more pro-growth strategy.
Now, let's not try to figure out what the Fed's next move is going to be. I think a more appropriate discussion would be if the Fed changed their mind partially due to the volatility and the way the markets moved, especially in the equity space at the end of last year. How are they going to respond to the renewed strength of this first quarter?
I think that there is a high correlation in the fourth quarter and this year between economic data and equity markets. So equity markets were weakening last year as Treasury yields were rallying because economic data was trending weaker in the United States very sharply at the end of the year, but also around the world. And the equity market this year is rebounding, I think, from probably oversold levels last year. But the Fed is most focused on data. And the U.S. economy is maybe bottoming right now. It's likely to do better over the course of the year. And I think that is what they will focus on. If equities continue to rally and the economy is weak, I don't think that will influence their decision a whole lot.
All right, I'm going to put you on the spot, Mike. I personally think the next 35 basis point move for interest rates in a tight time frame is going to be to the upside. What's your thought on that?
Good question. We think that there'll be no rate hike this year. The Fed will let the economy run hotter through the rest of the year, let it recover.
No, Mike, I don't mean in terms of the Fed. I mean in terms of the market itself. Just the Treasury market.
Bond yields. I think that we're near the bottom of the range, 250, 260 on 10-year Treasuries, given our view that there's unlikely to be a recession, but they're probably capped under around 3%. We saw 3% bond yields were quite damaging to the U.S. economy at that point in time last year. So it's hard to see them going much over 3. So up to 20, 30 basis points is probably a buying opportunity.